40%. That is how much the price of a standard hard drive component jumped in 6 months, because two countries you barely think about started firing artillery at each other. Not a chip shortage and not United States-China trade tariffs. It was two ASEAN neighbors having a shooting war across a border zone that most Singaporeans cannot find on a map. If you hold any SGX stock or REIT with manufacturing assets, logistics exposure, or concentrated revenue in Southeast Asia, this number is not someone else's problem. It landed in your portfolio whether you noticed or not. I had to run the regional trade data twice for this piece because I did not believe the depth of the collapse the first time. Most financial content is built around excitement, what is surging, what is breaking out, what you might be missing. I am deliberately building something different. Retirement-grade investing is not exciting. It is disciplined, forensic, and it is designed to still be working when you need it most. Let us look at what really happened. The Thailand-Cambodia border conflict of 2025 was the first direct shooting war between ASEAN member states in the bloc's 58-year history. More than 100 people were killed, over 1 million civilians were displaced, and 18 land checkpoints across 7 Thai provinces slammed shut. Monthly bilateral border trade, which averaged 16 billion baht in early 2025, collapsed to just 11 million baht by September, a near total wipeout of 99.9% that no yield spreadsheet in Singapore had priced in. Washington intervened in October. Beijing brokered a ceasefire in Yunnan on December 27, 2025, and then the trading forums went quiet again. But the structural vulnerability remains wide open. There are 3 things this conflict proved that your portfolio cannot afford to ignore. First, supply chain risk is completely invisible right up until the exact moment a border checkpoint closes. Second, ASEAN's 58-year no-war streak did not make intra-block conflict impossible. It just made everyone forget that it was a possibility. Third, a single market concentration soft flag in a forensic framework is not bureaucratic box ticking. It is your early warning system for exactly this scenario. Trade integration and military stability are not the same thing, and your dividend income stream cannot afford to treat them as if they are. Look at the deep economic integration that existed before the first shell was fired. Thailand and Cambodia had a 15 billion Singapore dollar bilateral trade target for 2025. Over 2 million Thai tourists crossed into Cambodia every year. Their factories shared workers, their farms shared supply chains, and their hotels shared guests. And they went to war anyway. Here is the forensic lesson: economic integration does not neutralize sovereign pride, territorial grievances, or sudden domestic political pressure. When those forces collide, the economic cost becomes a secondary consideration for the policymakers. Your portfolio cannot assume that 2 countries doing business together means they will never stop. When the conflict escalated, roughly 800,000 Cambodian workers were employed in Thailand. Within weeks of the fighting, approximately 780,000 of them went home. Overnight, Thai factories, including the ones that make hard drive components for data centers around the world, were running completely short-handed. That labor shock, combined with 18 closed border checkpoints and disrupted raw material flows, drove that 40% spike in procurement prices for standard hard drive components within 6 months. Enterprise-grade large-capacity drives rose nearly 50%. For a 55-year-old investor in BDOC or Toa Payoh, that is not an abstract data point. Think of it this way: every logistics operator, every data center, and every manufacturer sourcing IT equipment out of Jurong East or Kallang just saw their input costs jump. Higher costs compress profit margins. Compressed margins mean less free cash flow, and less free cash flow puts dividends under pressure. The second-order effect is the one that hits your grocery bill. When supply chain friction is sustained, it feeds straight into the import price index, keeping core inflation sticky. Singapore's core inflation is sitting at 1.4%, the cumulative weight of exactly these kinds of regional disruptions. Every distribution payout from your SGX holdings has to work harder just to keep pace with your monthly expenses. Now ask yourself the harder question. If the CPF special account still pays 4.0% guaranteed, and an SGX stock is offering you a yield that barely clears that floor while carrying unpriced cross-border risk, what exactly are you being paid for? This is why my 4.7% yield hurdle exists. The extra 150 basis points above the CPF rate is not a vanity premium. It is the minimum compensation for everything the CPF system does not expose you to: gearing risk, distribution cuts, and the possibility that a border checkpoint closes and the revenue your dividend depends on simply stops. One of the forensic soft flags in my framework triggers when a company draws more than 70% of its revenue or assets from a single country. A lot of investors look at that threshold and think they will just avoid obviously concentrated plays. But here is what the Thailand-Cambodia conflict demonstrates. You do not need a company to be headquartered in a war zone. You just need its key supplier to be operating in a factory 50 kilometers from a contested border, its labor pool to be sourced from the neighboring country, or one logistics checkpoint to close. The soft flag is there to identify the names that look perfectly fine until the map changes. Let the numbers on the macro evidence dashboard speak for themselves. Monthly border trade collapsed from 16 billion baht to just 11 million baht by September 2025. Hard drive component prices spiked 40%, and Thai tourism to Cambodia faced a full suspension. This has dragged Thailand's 2026 GDP forecast down to between 1.6 and 1.8% according to the World Bank and IMF current consensus. That is the lowest growth rate in the entire ASEAN bloc, while the regional average sits at 4.0%. Thailand is growing at less than half the regional average. That growth comparison is the one worth sitting with. While Vietnam is projected to grow at around 6 to 8%, the Philippines at 5.3%, and Indonesia at 5.0%, Thailand is limping along at less than 2%. That is a structural decoupling. Think about what that means for a 62-year-old investor in Punggol drawing down an SRS portfolio built around regional property assets and industrial companies. When the economy your asset is tethered to grows at under 2%, you are not looking at slow dividend growth. You are looking at a dividends at risk scenario the moment operating costs rise or occupancy slips. And operating costs are rising while the labor pool shrank by 780,000 people almost overnight. The local stock market has been voting with its feet. Capital is rotating away from regional exposure and into Singapore-centric names. The Straits Times Index reached a historical high of 5,037, not because everything is fine in the region, but precisely because it is not. That is what a flight to quality rally looks like. For electronics and semiconductor adjacent names like Franken, AEM, and UMS, we have to watch how component price spikes compress margins. For conglomerates like Jardine Cycle and Carriage, single market revenue slowdowns and currency translation losses are actively pressuring the numbers. For REITs with Southeast Asian asset focus, revenue degradation is the key metric to watch. Looking at the scenario matrix, the base case shows a ceasefire that holds, but trade fails to fully normalize. This keeps Thailand's GDP stagnating at 1.6 to 1.8%, which accelerates soft flags on names with heavy ASEAN single market concentration. The bear case introduces a secondary flare-up in the second half of 2026, which would test ASEAN governance frameworks again, prolong supply chain friction, and reprice the regional risk premium meaningfully higher. Before you review your next earnings report, run these 3 questions against every holding in your portfolio. Does your industrial or specialized electronics REIT have manufacturing assets in cross-border economic zones that could be disrupted by a checkpoint closure? Does your conglomerate draw more than 70% of its operating income from a single regional market that is now growing at under 2%? Is your SRS capital sitting in a name where the headline yield looks attractive, but the cash flow depends entirely on a single country revenue stream that a border dispute could freeze? The crash was never a surprise. In this market, the difference between a sanctuary and a yield trap is decided before the opening bell, not after the damage is done. The red flags are always there. The question is whether you had the forensic framework to read them in time. Iggy's elite investors did not chase the headline yield. They had the full forensic breakdown, the gearing ratios, the occupancy gaps, the debt overhang before the market opened and before the price moved. They get zero-day access to reports, the complete red zone watch list, and institutional-grade cheat sheets that flag the landmines disguised as opportunities. For 9 Singapore dollars a month, less than a kopi and kaya toast set at Raffles Place. You stop being the exit liquidity and start being the analyst. My personal sanctuary threshold, the minimum yield below which no open market investment justifies the risk you are taking on, sits at 3.2%. A sustained macro shock does not move that floor. It simply reduces the number of assets that can still clear it. For electronics and semiconductor adjacent names, the shock absorption question comes down to inventory buffers. When hard drive component costs jump 40%, a company's existing low-cost purchase contracts buy it roughly 90 days of insulation. After that, the higher input costs flow straight into the profit and loss account, and your distribution is next in line. For conglomerates with regional exposure, the buffer is balance sheet strength. How much single market revenue compression can they absorb before the payout starts to look stretched? A high nominal yield on an asset carrying a 70% single market concentration flag is not a bargain. It is compensation you are being offered for uncertainty that the market has not yet fully priced in. Compromising on your selection thresholds during a period of regional volatility is not opportunistic investing. It is speculative risk-taking dressed up as value hunting. Make sure your capital is flowing into names with balance sheets strong enough to survive a 4-month border shutdown without cutting distributions. If it is not, the 4.7% absolute minimum yield hurdle is precisely the tool that stops you from drifting in. If you are already drawing down your SRS or living off distributions, I want to be direct with you. A company can pay a reliable dividend for a decade and still see its cash flow disrupted in a single week. All it takes is its core revenue market closing, 18 land checkpoints, and sending 780,000 workers home. Your retirement income requirements are not flexible, which means your tolerance for unpriced geopolitical tail risk has to be close to zero. Review your portfolio for single country asset concentration. Check that your distribution stream is anchored to Singapore-centric names that benefit precisely when the region goes unstable. Can your retirement income stream survive a 4-month total border closure in its primary revenue market without a distribution cut? The Straits Times Index hitting a historical high of 5,037 is not evidence that the region is booming. It is evidence that capital knows exactly where to run when it gets scared. Money is leaving the border frictions, the growth downgrades, and the sovereign uncertainty. It is coming home to Singapore dollar assets, to the legal clarity, the accounting standards, and the currency stability that ASEAN's heartland savers have always taken for granted, but that institutional money has to explicitly seek out. That local market high is flattered by external instability, and that means the risks are still alive in the yield spreads of the names that did not get the memo. Picture a 60-year-old investor sitting at a kopitiam in Tempai. She is looking at a brokerage app showing an 8% yield on an industrial name with most of its assets concentrated along the Thai border. On paper, the maths looks compelling. In practice, that yield is a trailing indicator. It is what the company paid you based on a world where the border checkpoints stayed open, the Cambodian workers kept coming, and the factory floors kept running. The real risk does not appear on your screen until the distribution is already cut. Are you being paid enough for assets where the operational lifeline can be severed by a line on a map? This border conflict reminds us that regional integration is an illusion when sovereign friction takes over. If your retirement portfolio relies on unhedged Southeast Asian exposure, you are carrying risks that no historical yield can justify. I am Iggy, forensic investor, ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access, link in the description. The red flags were always there. For the full data table, sector breakdown, and 0-day updates to the single market watch list, join Iggy's elite investors on Substack. Elite investors get access 7 days ahead of free subscribers, and this is exactly the kind of analysis that lands in their inbox first. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a MAS licensed financial advisor before committing funds.